Hello everybody, this is Professor Chandana Goswami from Tejpur University. Today I will be discussing on how to deal with credit defaults, and this is a part of NPA management. A bank has the following options available for managing stressed assets. The first option is that it can exit from that account, which means that it will give up that loan account, shift it to some other bank who is willing to take up this risk. So this calls for early detection of stress and can lead the bank to make the borrower shift his account to another bank with higher credit appetite. So if your borrower Mr. X is not showing signs of regular repayment and you as a banker feel that it is likely to convert into an NPA, then you can request the borrower to shift that loan account to another bank who may have a higher credit risk appetite. The second is rescheduling or restructuring, and this has to be done in accordance with the revised cash flows, and maybe you can also consider granting concessions. Let us understand what the RBI guidelines talk about restructuring. Banks may restructure the accounts classified as standard, substandard or doubtful, but it cannot do with retrospective effect. Restructuring cannot take place unless changes are made in the original loan agreement with the formal consent of the debtor. Restructuring will be done only when financial viability is established and future cash flows look good. BIFR, that is the Board for Industrial and Financial Reconstruction, BIFR cases are not eligible for restructuring without their express approval. So we come to the third option available for banks, that is rehabilitation. For sick industries, a detailed viability study is done and the possibility of rehabilitation is considered. Fourth option, compromise. If the previous options do not yield results, then the bank offers some concession and tries to recover its dues. Fifth, legal action. The bank can go to a civil court, to a debt recovery tribunal, lok adalats, use the SURFACI Act 2002, or you will use the latest one, which is Enforcement of Security Interest and Recovery of Debt Laws and Miscellaneous Provisions of 2016, or the Insolvency and Bankruptcy Code of 2016. We will discuss this a little later. And finally, the last option available is write-off. So when all options are exhausted, the asset is written off by utilizing the provisions made for that account. So these are the options which are available for banks. Let's have a look at the details of the legal options we just mentioned. The first is civil courts. Banks can file civil suits for recovery of their dues in civil courts, but the proceedings are very slow and time consuming. So you have the option, banks have the option of lok adalats. Here they can settle disputes up to 20 lakhs. And RBI has instructed banks to use lok adalats for resolving cases involving amounts above rupees 10 lakhs. And with a quick settlement in the lok adalats, it is expected that this will reduce the stock of NPAs. Then you have the debt recovery tribunals. These were created for the banks and financial institutions for expediting cases involving excess of rupees 10 lakhs. Non-banking financial companies with assets of over 500 crores can also file recovery cases in these debt recovery tribunals. Then we have the Insolvency Act 2002, that is Securitization and Reconstruction of Financial Assets and Enforcement of Security Interest Act. This act is powerful. It provides for enforcement of security interest for realization of dues without the intervention of courts and tribunals. Creditors are authorized to enforce the securities and recover the dues from the borrowers. These financial assets can be sold by banks to securitization companies or reconstruction companies. This act was amended in 2004 to enable the borrower to make an application before the Debt Recovery Tribunal against the measures taken by the secured creditor without depositing any portion of the money due. So the borrower, if he does not like the measures taken by the creditor, can put an application to the DRT seeking, making an appeal, and he does not have to deposit any portion of his due money at this point of time. Second, provide that the DRT shall dispose of the application as expeditiously as possible within a period of 60 days from the date of application. So this borrower's application has to be disposed of within 60 days. A judgment has to be given. Third, enable any person aggrieved by the order of the DRT to file an appeal before the Debt Recovery Appellate Tribunal after depositing 50% of the amount due. So if the borrower is still unhappy with the judgment given by the DRT, can make another appeal before the Debt Recovery Appellate Tribunal, but this time he has to deposit 50% of his money which is due. Then you have the enforcement of security interest and recovery of debt laws and miscellaneous provisions. This act has amended the Insolvency Act and Recovery of Debts Due to Banks and Financial Institutions Act. So let's look at the amendments. Creditors can take possession of the collaterals in case of default of repayment. Has to be completed in 30 days with the assistance of district magistrates. No further court or tribunal intervention is needed. If a bank converts the outstanding debt into equity and holds a stake of more than 51%, then the banks can take over the management of the company. A central registry will be created to maintain records of transactions related to secured assets. So whenever we take a loan and we offer something as a security, that has to be recorded out here. Secured creditors will not be able to take possession over the collateral unless it is registered with the central registry. Then the amendments made to RDDBFI Act. This act established debt recovery tribunals and debt recovery appellate tribunals, the ones we have just discussed a few minutes back. Banks and financial institutions will be required to file cases in tribunals having jurisdiction over the defendant's area of business or residence or the bank branch where the debt is pending. So your jurisdiction can be defined either in terms of the branch where it is located, the area out there, or the borrower's area of business or the borrower's residence. So they become the jurisdiction. Presentation of claims and summons issued by the tribunal can be done in the electronic form. So this will speed up. Finally, we have the Insolvency and Bankruptcy Code. This is a single law for insolvency and bankruptcy. It outlines insolvency resolution processes, and these processes can be initiated by the debtor or by the creditor. Has to be completed in 180 days and may be extended by 90 days with the consent of the majority of the creditors. Licensed professionals will manage the insolvency process and control the assets of the debtor during the process. There will be two separate tribunals to oversee this process. The National Company Law Tribunal for companies and limited liability partnership firms, and the Debt Recovery Tribunal for individuals and partnerships. So these are the various options available before the bank when they think that they are going to face NPAs. Thank you very much.